Hello and welcome back to my podcast on all matters financial markets, brought to you by the Good Money Guide and by Pepperstone, who are kindly sponsoring this. And joining me, Michael Hewson and my good friend Michael Brown, who is Chief Analyst at Pepperstone here in the UK. So this week, we'll be looking back at the week just gone, obviously, to see what markets have done in the wake of last week's expected Fed rate cut. President Jay Powell's press conference was a bit of a non-event, as Michael correctly predicted. But I think what has been notable this week is that the dollar has maintained the strength that we saw in the aftermath of the Trump victory. But what we've also seen, and I think this is slightly more concerning, is we've seen yields continue to push higher. And Michael and I will discuss what that means potentially for cheaper money. And ultimately, I don't think it's a particularly good sign. This week, we've already seen 5 UK lenders raise their mortgage rates in the wake of last week's Bank of England rate cut. We'll also look at market moves in currencies, indices, bonds, crypto, which we didn't talk about last week, which is a little bit of an oversight, so slap on the wrist, and commodities. Just a reminder that you can find both Michael and myself on social media on X, previously known as Twitter, as well as LinkedIn. But before we get started, I have to do the necessary housekeeping and keep compliance happy with the risk warning. So here goes. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own financial advice before making any sort of decision. Spread bets and CFDs are complex financial instruments and come with a high degree of risk of losing money rapidly due to leverage. 75.1% of retail investor accounts lose money when trading spread bets and CFDs with this provider. So, Michael, let's absorb what's happened. I mean, obviously, you can sort of understand the dollar rallying and yields pushing higher. US 5-year and 10-year yields are their highest since June. So I don't think we need to be overly concerned about the rise in US Treasury yields, but I think there is a concern there that the new Trump administration, and he's been making appointments this week, some interesting appointments, noteworthy appointments, that raised a few eyebrows. Do you think that this move higher in yields can be sustained?
It was a very interesting week that we've just had. I mean, firstly, just to take a bit of a step back, I think the moves that we've seen fundamentally make a lot of sense. You know, we were talking this time last week. We've got not only Trump coming into the White House, but we've also got a red wave. And this morning it was confirmed that the GOP have retained control of the House. So they've got all three chambers, all three levers of power in their control for the next 3 years. So you for the next 2 years, forgive me. So you kind of go, well, what's the agenda going to be? It's going to be Trump to the max, effectively. And that means pretty much unconstrained ability to deliver tax cuts, deliver further government spending, and also to slap tariffs on whoever he wants to slap tariffs on. And I think the market's pricing not only that, but also the potential for a kind of tit-for-tat trade war akin to what we saw back in 2016, 2017 with the first Trump administration. So the macro impact of that is twofold. One is faster economic growth, because you get a bit of a sugar rush from when that fiscal stimulus kicks in. And the second is the potential risk of higher inflation because of the tariffs that are imposed, whether that be transitory price pressures or not. So you take that one step further, what does that mean in terms of monetary policy? Well, it means that the Fed, the risks around the Fed are becoming a lot more two-sided going into next year. It's not only a case where the Fed will do more if the labour market weakens unexpectedly. I think there's also an argument now that the Fed will do less if price pressures make a resurgence. And then from the fiscal side of things, you're talking about more unfunded tax cuts, which means greater Treasury issuance. So the question as to, can it be
More supply.
sustained? I think absolutely it can. Yeah.
Mm. What did you make of this week's US CPI numbers? Do those numbers rubber stamp a 25 basis point cut in December in your opinion? To my
Yeah.
mind, they don't, particularly when you look at weekly jobless claims
Mm.
today, which came in at a 6-month low.
Yes, agreed. I'm not overly worried about
Mm.
CPI. I mean, everything was pretty much bang in line with
I mean,
expectations.
the Fed doesn't target CPI for our
No, of
listeners
course.
and viewers. They target something called PCE, but nonetheless, I still think that there is a concern that perhaps core inflation could be stickier than perhaps central bankers would like.
Yeah, I mean, I think core inflation is clearly sticky. You're looking at 3.3% on an annual basis for core CPI. You're looking at 0.3% on the month, which is probably a couple of tenths above where the Fed would like it to be. But I think their reaction function hinges more on the labour market than it does on inflation at this point. And they are going to want to ensure that unemployment doesn't rise above, pretty much where it is now at 4.1%. And I think also, well, actually, Chair Powell speaks in a couple of hours after we finish this recording, so he may say
I think
something
they all
very
do
different.
actually.
But
Lagarde is on deck, and so is Andrew Bailey of the Bank of England. So
oh, I'm washing my hair sadly this
your
evening. I
mate,
won't be. Yeah, they're all my best friends. Our invitations for the Mansion House
or
dinner are
Bill
obviously in the
Bailey, as I like
post.
to call him, because he's about as much use as Bill Bailey. Anyway,
I think that's been
sorry,
a bit unkind to
I have to
Bill,
edit
actually.
that bit out.
But yeah, I think the Fed are really focused on the labour market at the moment, and unless we see remarkable strength in the November jobs numbers, then I don't really think the Fed are going to deviate from this sort of autopilot 25 bips per meeting. But next year it's a very, very different story when Trump's in the White House.
Yeah, I think though that you've got to remember the November jobs report tends to be seasonal because you get an awful lot of what I would call pre-Thanksgiving and pre-holiday
Hmm.
hiring, which tends to push the numbers up. Now we got a very weak number in the October report, I think, and that was because of the Boeing industrial action and the hurricane. So
Yeah.
I think it's going to be very difficult for the Fed to glean a clear sense of where the labour market is when you've got all of those factors.
Uh,
Because obviously the Boeing strikes, have they ended now? I think they
They
have.
they have ended, and I
So they're
think
going to
actually
come
that
back into the numbers. And then
yeah.
you're going to have obviously all the seasonal hiring that takes place in the lead up to Thanksgiving.
And I think it's a really good point. It is going to be difficult for the Fed to, kind of separate the noise from the signal in that November jobs report. But in that environment, you've got to ask yourself, what does a policymaker do? They're going to probably want to do the thing that they regret the least. And in an
Mm,
environment where the labour market is clearly slowing and disinflation is continuing, what will
mm,
you regret the least? Would that be delivering a 25 basis point cut that you might look back on and say, we went 6 weeks too early? Or would
mm,
you regret less holding steady and getting a really grim December and January jobs reports and then going,
mm,
damn, I wish we'd delivered that cut at the December Fed meeting. I think they'd
mm.
probably rather cut than not at this point.
You make a very compelling case, Michael, and you are slowly persuading me, but I'm not there yet.
Give it
I'm
time.
very
Give it a
much
few more episodes, mate. We'll be there.
I'm very much data dependent.
Oh no.
There was a rumor going around the market today. I think someone placed a big bet that the ECB is going to cut by 50 um,
In
at
December.
its next meeting. The market's not priced for that, and obviously the euro is down. It's down at its lowest level in over a year. I think largely on the basis of the fact of the stronger dollar, obviously, but also I think maybe there's a little bit of money going into a 50 basis point cut before the end
Yeah,
of the year from the ECB.
I think the curve discounts about 30 basis points.
Mm.
So we're not
It's all in
fully
the
we're
middle of that.
nowhere near fully pricing, but we're
Mm.
we're getting closer to kind of 50-50.
Mm.
Um, I think it
If
would
any
be tough.
region needs it, I would say it's Europe.
I would agree, but I think it would be tough for the ECB to justify it
Mm.
because you've what the problem that they have is central banks always want to anticipate and get ahead of the curve But when they come out and say they're data dependent, they can't anticipate things because they have to wait for the data to tell them what they were supposed to be anticipating 6 months ago. So I agree. Europe clearly needs a much more accommodative monetary policy stance. But then actually you kind of go 50 basis points, 25 basis points, heck, let's call it a whole percent. Is that sort of a magnitude of a cut miraculously going to turn around, let's say, the manufacturing industry in Germany?
I'm not
Absolutely
sure it's
not.
going to help anyway because European rates are much lower than UK and US rates anyway. So
Yeah.
they're already trading at a significant discount. So,
Kind
as
of
we talked
pushing on
about
a
last
string
week,
already, aren't you?
yeah. And we've got the PMI, we've got the flash PMIs for November next week, and they're probably likely to make for ugly reading. Okay, listen, I think we probably talked about that quite a bit. Obviously, UK 5 and 10-year yields are at 12-month highs. That's even more worrying given the fact that Andrew Bailey has suggested that while they're not on a predetermined path, more rate cuts are coming.
It's okay, though, because the Chancellor used to work for the Bank of England, so
Of
we're
course,
in
that's
safe
right. I was
hands.
forgetting that. Sorry. Silly me. Yeah, of course. She knows how to run an economy because I used to work at the Bank of England. Well, good job so far, Rachel. Anyway,
I don't want to get political, but I wouldn't let her run my bath. I do think it's kind of tough to decompose the degree to which gilts at this moment in time are being driven by the sort of global sell-off that we see being led by treasuries and the extent to which gilts are being driven by UK specific factors, basically
I
the
think there
fallout
is a
from the
premium
budget.
there, though. I
I
think
think
it's a
there still
small
is.
one. Yeah.
Yeah, exactly. And I think there are, one thing that is a little bit nerdy, I will admit, but one thing I'm going to be watching very closely is gilt auctions going forwards. I
Bid
think
to
it was
cover
last
ratios. Bid
week.
to cover ratios are essentially how much they're well, you can probably describe it better than I can. What the demand is for them.
Yeah, exactly that. So if you get a bid to cover ratio of 3, let's say,
Mm,
you've basically got 3 bids for every bond sold, which is
mm,
pretty healthy. If you
yeah,
have a bid to cover ratio of 1, you're saying that there is 1 bid for every
mm.
bond that is sold, and things are pretty ugly. And actually, the UK sold 10-year gilts probably about 10 days ago now, and demand at that auction was its lowest level since the back end of 2022,
What
which
was the
is
bid to cover? It was about two and a
uh,
half, wasn't it?
it was around that 2.4, 2.5,
Yeah.
something like that. I can't remember off the top of my
Which
head.
seems okay to me, to the layperson perhaps.
But in
But
the
if the average
context
is sort of
of,
three and a half, then
yeah,
perhaps you should have,
yeah. And I think
cause
it's
for
just a
concern.
little kind of amber warning light that
Mm,
goes, the
yeah.
market is clearly still suffering from indigestion around the
Mm,
budget. And it's not just gilts. I know, you mentioned mortgages earlier on.
yeah.
All the high street lenders in the UK are now starting to jack up mortgage rates. I think 2 and 5-year fixes are both back above 4%, and that's because
Mm,
swap rates are rising.
yeah.
So it's clear that
So if you can
it's a
explain what that means to your average listener.
yeah, of course. So mortgages are priced off something called swap rates, and
Mm,
swaps are effectively, to give a really simple explanation of it, the market's expectation of where rates are going to be in that period of time. So if you have a 2-year swap, which is probably at the moment trading about 4.1%, the market is saying that in 2 years' time, rates will be around 4.1%. Now, you've got a few other factors in there as well, like term premium, all that kind of stuff, but that's a kind of layman's explanation. And the really interesting thing is you've got central banks delivering rate cuts. The BOE cut 25 basis points a week ago, but market-based interest rates are moving in completely the other direction. And that's a really, really kind of interesting macro environment to be in because you see on the news and Andrew Bailey sits there and goes, "We delivered a 25 basis point cut today." But if you ring your mortgage broker up, your mortgage is becoming 10, 20 basis points more expensive every week.
yeah, give you a clue. My savings rates haven't gone up.
No, mine have gone down actually. Funnily enough,
Yes, and mine have too.
Mr. Diamond at JP Morgan Chase was very quick to cut the savings rate after
Yeah.
the Bank of England last
Not
week.
so not so quick to cut mortgage rates. So they're getting a nice
Yeah,
increase in their net interest margins
indeed.
on that basis. Okay, listen, I think we probably talked about that. Let me just recap the 5 banks who raised their mortgage rates this week: Santander, TSB, HSBC, Nationwide, and Virgin Money. So, and these are their fixed rates that they've obviously raised. So That is going to be a concern if you're a mortgage holder. And it's a concern if you're a saver because they're not getting passed on. So,
Mm.
sort of a bit of a win double for banks there.
And of
Um,
course, just lastly on that, the other thing with the UK mortgage market in particular is where one goes, everyone else tends to follow. So those
yeah,
five lenders have done it. The other
the rest won't be
5 or 10
following.
big mortgage lenders,
Mm,
we'll probably see them do it within the next couple of days as well.
yeah. Okay, well, let's wrap this particular discussion up because last week we previewed a few companies that were going to be reporting this week. On that list were Burberry, AstraZeneca, Vodafone, and Disney. Now, Burberry is one of the best performers on the FTSE 100 today, up nearly 19%. And you would think on that basis that they posted some really decent numbers. But I've just made a few notes here on this piece of paper.
So
The
someone's done his
company
homework, haven't
saw
they?
a 20% decline in same-store sales over the course of the last half year. 1.1 billion pounds in revenue, down from 1.4 billion pounds in revenue, and a loss of 53 million pounds compared to a profit of 223 million pounds. So a 19% rise in the share price, albeit it's really been battered this year. But what Joshua Shulman, the new CEO, has said is that he's going to make cost savings of 40 million pounds. He suspended the dividend, which normally causes the share price to crash, but that's probably been
Mm.
priced in anyway. And they're going to reduce inventory. Essentially, what he was saying, I think, from what I could tell, was that they were charging too high a price. People weren't buying the goods, and that's why the revenue saw a 20% drop off. So you're seeing this just something that's called Burberry Forward. Sounds really great, doesn't it? Burberry Forward. Let's take it forward. But the share price is up 19%. Seen a decent rally today. Maybe, just maybe, we'll get a push higher because it's taken it up to the highest, probably highest levels since June. Big question is, it's approaching technical resistance now at the 200-day moving average. Will it push above that?
Yeah, I
So,
think this feels like a classic case where there was so much bad news priced in that
mm,
almost no matter how bad the results were, unless revenue was zero or something stupid, no matter how bad things were, it was always going to be tough to engineer a sustained sell-off in the stock because, as you alluded to, they completely canned their dividend. Normally, you'd see a stock fall through the floor. Burberry
yeah,
haven't, they've actually rallied. Why? Well, because I think the market was expecting it. One little nugget I did think was quite interesting in the results, and clearly the rally is fueled by this cost cutting plan and the optimism around that. But a little nugget in there that I did find interesting: China sales down 24% in the first half of the year compared on a year-on-year basis. So that just speaks to what we were talking about last week in terms of the
mm,
broader, well, are Burberry luxury? I don't know these days. As you can tell, if you're watching this, I'm not the most fashion-forward person in the world, but it does
what
speak to.
I am. Come on,
Well, for those of you who are
me,
listening,
a middle-aged man,
we're
and you
both wearing the
sort of a
same
middle-aged
jumper
man
here. So,
tone, if not age. Sorry,
but
Michael. Giving the grief about that.
oh, you've started me off now. But no,
No,
I do
sorry.
think it speaks to the broader trend of a slowdown in China, which
Mm,
we've seen in a lot of the other luxury names, and it's clearly showing no signs of getting any better anytime soon.
yeah. Okay, so moving on to Vodafone. I mean, it's a bit of a mixed bag looking at it, and the shares did basically finish the day down on the day. Total revenue was up 4.2%, which was fairly decent, but their biggest market, Germany, came up short. That slowed. The merger with Three is on track. The CMA is due to make a decision on that on the 7th of December. Really, I don't think there was really much to write home about that with respect to Vodafone. It was a bit of a non-event. The shares have rallied in the last couple of days, but it had a poor day when the numbers were released.
Yeah, I think your summary of it there is pretty much spot on. To be honest with you, when I was doing my homework, it was actually sort of difficult to pick out anything from the Vodafone earnings that was really worth commenting on. I think it was
Mm,
pretty much very much as we expected. I guess the big date for Vodafone is this CMA decision on the Three
yeah,
merger and whether that gets the green light or not.
Well, I think it needs to get the green light. I think if anything, just to, I think, um, try and make sure they can consolidate their core markets, and their core
Hmm.
market is UK, core market is Germany. They've got rid of their Spanish one. They're getting rid of the Spanish, and they're getting rid of some of their Italian assets, perhaps as well. And I
Yeah,
think that's where they need to focus their attention on the core markets of Germany and the UK.
absolutely.
Right, moving on to AstraZeneca. These were fairly decent numbers. I like them. Guidance was raised, 19% rise in revenue, 9 months to date, 39.2 billion. China troubles, they were a cloud. Pascal Soriot acknowledged that, CEO. But what was interesting, I think, for me here, Michael, was the fact that it wasn't so much about the numbers were good. It was the investments that they announced, and compare and contrast the US and the UK.
Hmm.
US, they announced $3.5 billion of US investment. But here in the UK, £450 million investment in Speak in Liverpool for a vaccine factory that's put on pause.
Hmm.
And
Yes.
why? Why? Okay, I'll tell you why. Because apparently the UK government is quibbling over the amount of state aid that they're going to give to AstraZeneca to open this factory and the thousands of new jobs that will be created. The previous government was having, the Conservative government was having conversations over £90 million. Now, Labour wants to reduce this to £40 million. Now, I'm very tempted to spit out an adjective here. We're talking 50 million quid. It's a rounding error. The taxes alone on the new jobs will more than cover that. Why are they quibbling about 50 million quid?
It is utterly ridiculous. I must admit, I was shocked, and my blood pressure almost went through the bloody roof again when reading this story. Um, it's ridiculous, to be completely honest with you. My first when I first saw the headlines, I thought, this is just another example of a company playing hardball and just trying to get a
Mm.
bit more money. But actually, it's not. It's the government turning around and being tight for no
It's
reason. I mean,
pocket change. It's pocket change.
exactly,
22 billion
exactly
on carbon capture, and they're quibbling about 50 million quid, for crying out
Exactly
loud.
that. It is a joke. And when you've got, Rachel Reeves and, God knows who else, Keir Starmer, everyone else in the cabinet saying, we're going for growth, we're fixing the foundations of the economy, we need to engineer economic growth. Well, you don't engineer economic growth by pissing off the biggest companies in the world and sending them
Mm.
to go and invest in other economies, excuse my language. And
AstraZeneca is the
Astra,
second biggest company in the FTSE 100,
yeah,
behind HSBC.
and they're not going to be alone in making this decision.
Mm.
I think this is just a broader sort of illustration or a symptom of what's
Mm.
going on. Astra are not going to be the only large corporate out there going, we don't want to invest in the UK anymore.
Well, why would they? I mean, if the government's penny pinching on stuff like that, I mean, no one's saying that they should be getting handouts. But one of the joys of Brexit was that we could, offer state aid to certain companies to help them basically grease the wheels of creating jobs in areas where perhaps they probably wouldn't be considering it. And now here we are, they're at a bit of an impasse. My hope is that common sense will prevail here, and AstraZeneca will basically get the money, and the factory will eventually get built and open. Anyway, so
Well,
that's.
you would certainly hope so, but sadly, common sense is not very common these days.
I think what we should call. Well, I think we should call this podcast "Two Michaels Ranting."
Yeah. Or just have the,
Anyway,
the, the little thumbnail as a picture of Victor Meldrew twice.
yeah. I don't believe it. Anyway, we'll finish off with Disney. But Disney shares, just looking at the moment, are up 7% in US trading. Decent set of numbers. They added 4.4 million subscribers in their Q4. We're only expecting an add of zero point 0.7, so 700,000. So that was much better than expected, taking global total subscribers to 158.6. The streaming business actually managed to generate a profit. Good news there. Inside Out 2 and Deadpool helped with respect to boosting revenues. For 2025, they did talk about the impact of Hurricane Milton and Hurricane Helene. $130 million they reckon it's going to cost them in operating income impacted to the tune of that amount. And they're also spending an extra 90 million on Disney Cruise Line's pre-launch costs for 4 new ships. So it's back above $100. Maybe Bob Iger is doing the business.
Yeah, I mean, there's nothing really to complain about there, is there? Top and bottom line beat, subscriber
Yeah.
growth looking pretty healthy. I mean,
$3 billion in buybacks.
$3 billion in buybacks. Why wouldn't the stock be up?
Yeah.
5, 6, 7% on the day. It's a very, very solid set of earnings, and the indications are in terms of guidance that they look set to continue on that sort of optimistic course in the next quarter or so. So yeah, I think well, for the bulls certainly it's an ideal corporate earnings slate.
So I mean that sort of recaps the companies that we previewed last week. Going to just break a bit here and talk about Lloyds Banking Group. That's been in the news recently, pretty much for all the wrong reasons, because of the involvement of its Black Horse Finance division, which is a key lender to the car finance industry, and a recent court judgment that stipulated that hidden commissions were illegal and could be liable for compensation. And an awful lot of people are saying this could be as big as PPI. That caused a pretty big sell-off in the share price in Lloyds Banking Group from 63p back in October down to around about 52, 53p at the end of last month. What do you make of that, Michael? Is it something to be concerned about, or is it perhaps just a little bit of nervousness because there's some concern they may have to pay out an awful lot of money, or is it because it could impact a wider range of financial products apart from car finance?
Yeah, I think this is something to be quite highly concerned about, not only for Lloyds, but in terms of the UK banking sector more broadly, because we know that a lot of domestically focused retail banks have been, highly active in terms of car financing loans in the past. And also earlier this week, we saw, I think it was the FCA actually widen the scope of what can be of what they propose consumers can claim for in terms of these schemes. I'm not entirely sure on the specifics of it, but I think it was previously just if I'm pretty sure, don't quote me on this, previously it was a case of if consumers received a higher rate because the broker got a higher commission. I'm pretty sure the scope of that has now been widened quite considerably. So even though I think back in February, Lloyd's put aside some provisions for this, it's now looking like those provisions might actually not be significant enough because the scope has been widened. And also, as you alluded to, are we now in a situation where we start looking at, first it was PPI, now it's motor finance. What other sort of skeletons might be lurking out there in terms of other financial products that may have been missold at some point in the last decade, and at which point the regulator may come knocking?
I think the problem here is that originally it was with respect to hidden commissions, and the fact that there were incentives on the dealers, on behalf of the dealers and the finance company, which the consumer didn't know about. I think it's been broadened out to now all commissions.
Yes,
Now,
that's
the
right.
big concern I have about this is that even if you know about the commissions, why are commissions illegal? Everyone pays commission. You pay a financial advisor to look after your pension. There is a commission. There is a charge every year that they essentially charge you for looking after that money. The big concern I have is going to gum up the consumer credit artery of the economy, because banks will just go, well, hang on, I'm just not doing this.
Well, Close Brothers already have. They are one of the oldest merchant banks in the UK. They're in the FTSE 250, not the FTSE 100. But they have already said we're stopping all auto lending until we have some clarity on this. I was just digging into that a little bit more, actually. So you're absolutely right in terms of the way that definition has changed. Lloyd set aside a provision back in February of about 400 million, 450 million for costs that might be associated with this. Now that the definition's been broadened, in a worst case scenario, they could be looking at a bill 10 times that.
Yeah, I mean, I think that's the worry. I mean, to be quite honest, I think that's the worst case scenario. I think the FCA would be very foolhardy to say that all commissions should be
That's never
banned
stopped them, has it?
because it's just ridiculous. I mean, that's how financial markets move, but that's how
Yep.
they're lubricated by commissions, the payment of this for a service, payment of that for a service. That's essentially what a commission is. So
Absolutely.
for me, I think this is impacting Lloyds probably more than any other bank. But you pay mortgages, you pay commissions on a mortgage. You
Yeah.
pay an administration fee if you want to, and that can be up to £1,000. I mean, that's just crazy. But you know that in advance.
Yeah.
And you have a choice as to whether or not to pay that or not.
Exactly that. And also, I don't want to get into a regulatory debate, but if commissions are displayed clearly and upfront and are not disproportionate, there should be no issue with that. Because, as you
And
say,
that's what
that is
competition's
how
for.
exactly that's what competition's for, and that's how the financial system works. That is ultimately why there are so many brokers, whether it be car finance, mortgages, estate agency, whatever. Everyone is working on commission for the services that they're
So
providing.
commissions needn't be a dirty word. It's what
No,
makes the world go round. So I think there needs to be a little bit of a common sense approach. No one is arguing for, backhanders or anything like that.
no, no,
None
no,
of
no,
that.
no.
As long as it's transparent and everyone knows and they can shop around and see what's like with like, then I honestly don't see a problem. And I think at some point this will probably come out in the wash and Lloyd's will potentially start to go higher because I think the share price should be higher. I certainly think it should be higher. It's more profitable now than it was in 2015 when the share price was between 85 and 90p. It's in much better shape now. It's had a fairly decent 9 months over the course of the last, so far this year. I mean, you look at the numbers and the numbers look fairly healthy. The net interest margin's 2.95%. The Black Horse Finance, it's got loans totaling up to £16 billion. Well, their whole loan book is £475 billion. So it's a very small fraction of their entire loan book.
Yeah.
And their loan book went up this quarter, and total deposits went up this quarter. So when you actually look at the numbers, yes, they're talking about this being the new PPI. I struggle with that because Lloyds set aside £22 billion in PPI provisions over the course of the last, which I think from 2019
Yeah.
up to 2019. I don't think we're even going to get close to that when it comes to this particular effect. But I think
No, I guess the only thing is until this is not necessarily over, but until there is some concrete information around who can claim, what is liable to be claimed against, and the approximate cost that may incur to the lenders in question. Until those three things are known, nobody is going to have that much conviction to take Lloyds on a huge rally or any UK bank because there's just too
the
much
case has gone to
uncertainty.
appeal. The case has gone to the
Yes,
Supreme
naturally.
Court to appeal. And the FCA have said, can you speed this up, please? And, I'm on the side of the FCA here. Yeah, speed it up. Well, we need some sort of line drawn under this.
Yeah.
Because ultimately this is not good for the UK. It's not good for the UK finance industry to have this cloud hanging over it.
Yeah.
Certainly
No,
in
I
terms
agree.
of the numbers, you can read about what I've written about. That's a terrible way to put it. You could read about what I've said about Lloyds and what we've talked about Lloyds today on the Good Money Guide website in the news section. So that goes into slightly more detail with respect to the numbers than we've sort of really talked about here. We just talked about the wider concerns about the commissions and pretty much everything else. Okay, so that's wrapped up Lloyd's. Now let's look at next week.
Yeah, there's a few interesting bits and bobs next week, isn't there?
Yes, there is, and I think we've been running for about, I don't know how long we've been going, 35 minutes. So let's not make this longer than 45 minutes. So let's wrap this up because we've got quite a bit to get through. UK inflation, UK CPI. So we talked about this a little bit, I think, last week. We talked about wages and obviously unemployment, the numbers that came out this week. They weren't great, if I'm at all honest with you. The wages numbers were okay, but they edged higher. Unemployment went up to 4.3%. Again, that's a bit worrying, but again, it really depends on whether or not you believe the numbers. But inflation, expecting that to tick back up again, aren't we?
We are, yes. Although I would caveat that by saying that, of course, this is October inflation data. So we did have quite a chunky rise in energy prices. Ofgem's price cap went up again. So that is going to be feeding into the data. Of course, the BOE are continuing to look at the core and the services CPI metrics. Now, the Monetary Policy Committee were very clear, I think, in their most recent statement that they are not planning on stepping up the pace of hikes anytime soon.
Cuts?
And we've of
You
cuts
mean
even.
cuts?
Yeah,
Yeah.
blimey, sorry, I was channeling my inner Richard Matthews, our
Yeah,
mutual friend there. The BOE are not planning on speeding up cuts anytime soon, to be clear. And even Catherine Mann, one of the external members on the committee, she hasn't even voted for a single cut just yet. So I think we might see further disinflation in those underlying price metrics, but certainly nothing that will force the BOE into doing anything in December, especially
No.
when headline's going to tick back above the 2% target.
And core is at 3.2 and services is at 3.9. So,
Yeah.
it's still fairly unlikely to go higher once those public sector pay rises start to filter in.
Yes, and that will
We've
only
got
come in
retail sales
Q4.
as well. Sorry,
Oh, sorry, mate.
We've got retail sales as well next week as well on Friday. So it'll be interesting to get an insight into consumer spending in October.
Yes, indeed. And of course, the survey period for the retail sales print will be before the budget. So it will really capture that kind of last 2 or 3 weeks where we had all of the pre-budget news being trailed in the media. And we also had a really big hit to consumer confidence at that point as well. So I think it's tough to imagine an impressive retail sales number in October. I think people are just going to have tightened their belts, of course, not only with the uncertainty, but also 2 months before Christmas gets underway.
Well, there's also the fact that obviously with the energy price cap going up, they'll have had less money in subsequently, so they'll want to hold some of it back.
Yes, absolutely.
Okay.
It's all good news on the
EU
UK economy, isn't it? Bloody hell.
I know. You got EU CPI next week. Not really expecting any surprises there. 2.6 and whatever, 3%. That's just a reaffirmation of data that was released earlier this month. On the earnings numbers, we've got JD Sports, third quarter numbers on the 21st. I'm assuming that is still the 21st. I've said a couple of dates last week, which turned out to have been shifted. But when I checked, it was the 21st.
Just blame me for
this
giving
week,
you dodgy
the company
data. CEO
of JD Sports, Andrew Higginson, who's also chairman of the British Retail Consortium, said that the budget is going to add around about £400,000 or something like that, or 400, a lot of money anyway, to JD Sports's underlying costs. So not winning any friends there, Rachel, either. Yeah, it'll be interesting to see what their numbers say with respect to like-for-like sales. Certainly, it was in their business in North America was basically helping to offset weakness in the UK.
Yes, and of course they are not alone in having a massive increase in costs as a result of the budget. They are just one of many to confirm what that cost is likely to be, and definitely not pro-business, let's put it that way.
Well, it turned out to be the last straw for Homebase, didn't it? Because
it did.
Ultimately they've announced that they've gone into a pre-pack. Well, not this week, they've gone into a pre-pack, and some of their shops are being bought by the range.
Yes.
So, but that still means potentially another 1,500 jobs that could go there.
Yeah.
Some of these retailers are very much on a knife edge.
They are, and I hate to say that we said this would happen, but we did say this would happen.
We did. And right, okay, I'm going to skip over. There's a couple of real estate investment trust reporting next week. Workspace and British Land. Be interested to know just what their occupancy rates are like, whether or not they're seeing any stresses and strains from some of their tenants, who tend to be retailers or big businesses. We've got Walmart and Target in the US, third quarter numbers. That, I think they're going to be particularly interesting, given the fact that Walmart, US's biggest retailer, its share price has done that. It's
Yeah.
probably one of the only retailers that's done that.
For our listeners, what Mr. Houston is doing is drawing a line up and to the right.
From the bottom left to the top right.
Yeah. And it's been remarkably straight over the last
Yes,
year or so as well.
it has. I mean, Walmart has probably taken the fight to Amazon when it comes to basically dominating the US retail market.
Yeah, very much so.
So
and
it'll
also
be
they will
interesting
just
to see.
those two will also be a useful barometer of consumer sentiment and spending as we move into the big sort of fourth quarter, which in the US is huge. Obviously, you've got
Exactly.
Thanksgiving,
We've
you've
got
got
Black
Black
Friday coming up.
Friday,
We've
you've
got
got
Prime deals.
Christmas.
We've got
Yeah,
all of this stuff.
yeah, absolutely pivotal.
So, as I say, Target is probably another ubiquitous US brand, or Target, as it's sometimes known, because it sounds a bit posher.
Who on earth
Ultimately, I
calls
think
them that?
trust me. In the US they do. I've got US relations, and they say off to Target today because it
That's
sounds a
like
bit posh. It's
Hyacinth
basically
Bouquet, isn't it?
exactly that. It's exactly that. But Target has had slightly more problems when it comes to the fact that it's suffering from what they term as shrinkage, which is essentially code for shoplifting and losses as a consequence of that. They've closed a number of stores in some of the more seriously affected areas, and they're expecting quarterly revenues of around about $25.5 billion. So it'd be interesting to see whether or not they raise their guidance. Be interested to see whether or not Walmart raises its guidance, because I think one of the things that retailers have always complained about is margins, but Walmart bucked the trend every single time. It's beat on revenues and it's beaten on profits. Target, not so much.
Yeah.
And we'll finish up with Nvidia.
I was worried you were missing
No, Nvidia.
what some people, and I need to be careful here because this includes my boss, have been calling the most important stock in the world.
Well, yeah, I suppose it is. I mean, I was looking at the numbers for Nvidia, and I've been watching Nvidia. I mean, I've known about Nvidia since the early 2000s, when it made basically just gaming chips. That was their biggest revenue earner, gaming chips, and they still make an awful lot of money on gaming chips. They saw a 16% rise in revenue to $2.9 billion in Q2. That was their biggest revenue earner until AI. And now their revenue in Q2 is it was $26.3 billion, of which only 2.6 billion was 2.9 billion was gaming chips. AI chips have completely blasted the financials of that company into the stratosphere. And essentially that's why we've seen Nvidia make the gains that it has, because it's got first mover advantage, and essentially it's the only company in the world that makes these chips.
Yeah, and I think that's really the key thing for the stock going forward is, are they going to maintain that first mover advantage, and can they maintain the, well, frankly, remarkable growth that they've seen over the last, well, it's really only the last 2 or 3 years. Is that a pace that can be maintained, or is there a moment coming up where, Intel, ARM, AMD, Qualcomm, anyone else suddenly catches up to them and they no longer have a sort of monopoly here? I think the other thing that I'm going to keep quite a close eye on in terms of Nvidia is there does seem to be a bit of a perception, talking to market participants, that risks around AI have become a lot more two-sided. And what I mean by that is, from the companies implementing AI perspective, this time last year it was a case of, Meta's doing this with AI, Microsoft's doing this with AI, we're going to spend 10 billion, oh well, we're going to spend 12, or we're going to spend 14. There was almost a bit of a kind of arms race, and everyone was getting all very, very overexcitable about that. Now everyone's kind of gone, well, you've spent 10 billion or 15 billion in capex. What have you got to show for it? And when are you going to have something to show for it? So I think one thing that will be interesting to gauge from Nvidia is there still this kind of insatiable demand for their tech, or are things starting to cool off a little bit as, you know, perceptions around the theme begin to moderate somewhat?
Yeah, I mean, I was looking at the Nvidia share price, and I'm looking back in, let's see, a year ago. Okay, 1st of November 2023,
Hmm.
the Nvidia share price was $40, right?
Where are we now? 120 odd, isn't it?
147.
We're up at 147 now.
Yeah, we're not quite at $150 yet, but I think we probably have been up there. Just
Mm.
looking at my chart, $149.80. So, yeah, I mean, that is exponential. You know, it's made it almost the world's biggest company alongside Apple.
Yeah.
And on margins, gross margins of 75%.
Crazy, isn't it? It is crazy. And on the one hand, you go, this is ridiculous. But also on the other hand, you kind of go, well, actually, it makes complete sense because, you know, as you alluded to earlier, they're the only company out there that make what is necessary to effectively make all of the AI stuff work for,
Mm.
you know, to put it in layman's terms, you know, and so long as they maintain that sort of monopolist position, then, you know, you'd argue that things should probably carry on as they are.
You'd like to think so. I mean, with margins like that, you'd have to argue, well, perhaps maybe the only way is down, and is that priced in? But no, they've got three chips. They've got the H100, the Blackwell B200, and the GB200.
Really
You
catchy
know,
names, aren't they?
they are, aren't they? The Blackwell B200. I'll have a couple of them, please.
Yeah.
You know, and it's now in the Dow, which is your favourite index. I
Oh,
know. But
oh no.
for those
Oh.
of you who are listening, Michael has just put his head in his hands.
And had to stop because I was going to knock my microphone off my desk. Which, given I was about to go on an expletive-laden rant, might have
Yeah.
actually been a better situation.
So let's just say for Nvidia next week, they expect to see revenues in the third quarter of $32.5 billion plus or minus 2% on margins of between 74 and 75%. Now, just let me remind you, that's almost 6 billion more than the previous quarter total revenues. I
It
mean,
is a
I only stretch on
formidable
a
place of
quarterly,
growth, isn't
on
it?
an annual basis, a 6 billion increase in revenue is huge. This is on a quarterly basis, a
Yeah.
6 billion increase in revenue.
It's actually hard to contextualize and get across how staggering this growth rate is.
It is. It is. And on that note, I think we should wrap this podcast up because we've gone on for 49 minutes. And if you haven't fallen asleep by now, well, there you go. Anyway, so that's it for this week. Hopefully we'll revisit these numbers when we talk next week. And hopefully we'll get a better idea of the longer term prospects. As I'm looking at my charts now, I can see the FTSE's around about post market, it's around about 8,060 now. So not a good day for the FTSE. But yeah, so that's it for this week. Hopefully you've enjoyed this second podcast. And please leave your comments below. If you've got any questions, email me, michael@goodmoneyguide.com. I said it right this time. And see you all same time next week. And once again, Michael, thanks for joining me for what is a very enjoyable conversation.
No, thank you, mate. We'll see you next week.